$84 trillion. That's more money than the entire global stock market, more than the GDP of every country on Earth combined. And yet, most people have never heard of the market I'm talking about. This invisible $84 trillion force quietly controls your mortgage rate, your credit card interest, your retirement savings, and even whether companies can afford to hire new employees. It's not crypto, it's not stocks, and it's definitely not sitting in some billionaire's bank account. So what is this mysterious market that dwarfs everything else in finance? And more importantly, why should you care about something you've probably never heard of? The answer will change how you think about money forever. We're talking about the global bond market. And before you click away thinking this sounds boring, hear me out, because this affects you way more than you realize. A bond is essentially an IOU. When governments need money for roads, schools, or military spending, they issue bonds. When companies need cash to build factories or expand operations, they issue bonds. When you buy a bond, you're lending money to that entity, and they promise to pay you back with interest. Now here's where it gets wild. This market is absolutely massive. We're talking $84 trillion in outstanding bonds worldwide. To put that in perspective, that's about 4 times larger than the US stock market. The entire crypto market? That's less than 1% of the bond market on a good day. But here's the thing most people don't understand. Bond prices and interest rates move in opposite directions, and when they move, everything in your financial life moves with them. Let me show you exactly how this invisible market controls your money. When you apply for a mortgage, the bank doesn't just pick an interest rate out of thin air. They look at government bond yields as their starting point, then add a premium based on your risk. If bond yields go up, your mortgage rate goes up. Credit cards, car loans, business loans, they all follow the same pattern. But it goes deeper than that. Remember the 2008 financial crisis? That started in the mortgage market, but it spread to bonds, which then infected everything else. Or think about 2022, when inflation spiked and bond prices crashed. Suddenly, mortgage rates doubled, the stock market tumbled, and even stable companies started laying off workers. Why? Because when borrowing becomes expensive, everything slows down. Companies can't afford to expand, consumers can't afford to buy homes, and the entire economy feels the squeeze. This is the power of the bond market. It's like the circulatory system of the global economy. Now here's where most people get confused. Who actually owns these $84 trillion in bonds? The answer might surprise you. The biggest players aren't Wall Street traders or billionaire hedge funds. The largest bond holders are pension funds, insurance companies, and central banks. In other words, institutions that manage money for regular people like you and me. Your retirement account? It's probably 40% bonds, even if you've never thought about it. That insurance policy you pay for every month? The insurance company invests those premiums largely in bonds to ensure they can pay claims. Even your bank uses bonds to manage their cash reserves. This means that when the bond market moves, it's not just affecting some abstract financial system. It's directly impacting your retirement savings, your insurance premiums, and your bank's ability to lend money. The craziest part? Most people have no idea this is happening behind the scenes. But here's where the story gets really interesting and why understanding bonds can actually make you money. Most investors completely ignore the bond market and focus only on stocks, but some of the smartest money managers in the world spend most of their time analyzing bonds. Why? Because bonds often signal what's going to happen to stocks months before it actually happens. When bond yields spike suddenly, it usually means inflation fears are rising, which tends to hurt growth stocks. When bond yields fall rapidly, it often signals economic trouble ahead, which can impact the entire stock market. Warren Buffett doesn't just buy stocks. He pays very close attention to bond markets to time his moves. During the 2008 crisis, while everyone was panicking about stocks, the smart money was watching bond spreads to identify when the crisis would end. Understanding this relationship can help you make better decisions with your own investments, even if you never buy a single bond. So what does this mean for you practically? First, understand that when you hear news about interest rates, inflation, or central bank policy, they're really talking about the bond market, and that affects your life directly. Second, if you have investments, don't ignore bonds completely. While they might seem boring compared to hot tech stocks or crypto, they serve as a crucial stabilizer in your portfolio. Finally, pay attention to bond market signals when making big financial decisions. Planning to buy a house? Watch where 10-year Treasury yields are heading. Considering a job change? Look at corporate bond spreads to gauge economic health. The bond market might be invisible to most people, but it's the foundation everything else is built on. And now that you know about this $84 trillion giant, you can use that knowledge to make smarter financial decisions. What's one financial decision you're thinking about where bond market trends might influence your timing? Let me know in the comments. And don't forget to subscribe for more money facts that actually matter to your wallet.